Welcome to KPMG's podcast on ASU 2014-12, determination of whether a performance target that is allowed to be met after the requisite service has been provided by the employee is a vesting condition or a non-vesting condition. My name is Jared Silver, and I'm a senior manager in KPMG's Department of Professional Practice. With me today is Dan Amat, also a senior manager in KPMG's Department of Professional Practice. Dan, can you provide us a background as to what types of situations this ASU is meant to address?
Yes, thanks, Jared. This ASU was very specific, and it relates to companies that grant share-based compensation awards that include a performance condition and permit employees to earn the awards even if the performance condition is achieved after the requisite service has been provided. So, for example, non-public companies may issue awards that only transfer upon an IPO. Companies may also offer awards with an earnings-based performance condition to retirement-eligible employees who are not required to perform future service to receive those awards.
Thanks, Dan. So, I know that the ASU did begin as an issue with the EITF. Why did the EITF take this issue up in the first place?
Well, there was diversity in practice, which led to some big differences in the accounting answer. Under current practice, some companies considered the terms of these awards as performance conditions, and under this view, companies would recognize compensation expense only if the achievement of the performance condition was probable of occurring. There was a second view that companies considered these as post-vesting restriction and incorporated this contingent event into the calculation of the grant date fair value. The ITF discussed each of these views that result in differences for both the measurement and the timing of compensation cost. A final consensus was reached that a performance target that can be achieved after the requisite service period should be treated as a performance condition of an award. That final ASU was issued in June 2014.
Thanks, Dan. Now, let's go through an example. I think that'll help our listeners today. So, say I'm a code developer at a software company. This company gives out performance awards that, we'll say, pays out once the company goes public. Let's say in about 10 years. If I'm only required to work for 3 years until I am vested, how would the company record this, assuming I'm still eligible for the awards?
Yes, this is one of the more common cases where you'd see this type of award characteristic. Situations where a company is hoping to go public someday. To answer your question, let's say you receive the shares that only require you to work for a set period of time, like you stated, 3 years. But you're allowed to vest in those shares even if the IPO were to occur within the next 10 years. We'll say it becomes probable in year 4. Let's also assume that the fair value on the grant date of those awards is $100,000 without consideration of the contingency of the IPO, and then $70,000 if the terms of the award are considered a post-vesting restriction. Under this example, and based on the final ASU, for those 3 vesting years, no compensation costs would be recorded while you were providing those services to the software company. All the compensation costs, $100,000, would be recorded in year 4 when the IPO is deemed probable.
Thanks, Dan. That is helpful. So let's just summarize what you just discussed. So say the performance condition would not be reflected in estimating the grant date fair value of the awards. So if the performance target is not probable of being achieved prior to the end of the requisite service period, the compensation cost would be recognized when the achievement of the performance condition is considered probable, in year 4 of the example we walked through.
Yes, that's correct. No compensation costs recognized during the 3-year service period because that IPO was not deemed probable yet. Also, any previously recognized compensation costs would be reversed if the performance target was previously deemed to have been probable and then later was deemed to no longer be probable, or if the award was forfeited before the service condition was met.
Thanks, Dan. Now, one follow-up question in regards to that. What treatment would be required for grants made to retirement-eligible employees?
Well, for retirement-eligible employees who may receive their awards without providing any future service to the entity, if achievement of the award's performance target becomes probable, similar treatment as we discussed in our example would be required.
Thanks, Dan. That has been helpful. Now, in terms of transition to the new standard, can you share with everyone how that will work?
Sure. Preparers can apply a prospective approach to all share-based payments granted or modified on or after the effective date. For those who want more comparability, the ASU also allows for a retrospective approach for all awards with performance targets that are outstanding as of the earliest period presented upon adoption, with a cumulative effect adjustment as of that earliest period. The effective date for this ASU for public companies is at interim and annual periods beginning after December 15, 2015, and then for non-public entities, it's effective for annual periods beginning after December 15, 2015, and then interim periods in the following year, so 2016 for calendar year companies. Additionally, early adoption is permitted.
Thanks, Dan. That concludes this podcast. For information like this on other ASUs, please visit our KPMG Financial Reporting Network website at www.kpmginstitutes.com/institutes/financial reporting network.